Now we're going to talk about the prior service cost and the amortization of the prior service cost. Eventually, we will calculate the worksheet, taking these into account, and show you how that's done as well. So the prior service cost. When either initiating or adopting or amending a defined benefit plan, a company often provides benefits to employees for years of services before the date of initiation or amendment. As a result of this prior service cost, so before the point of the amendment or the adoption, the projected benefit obligation is increased to recognize the additional liability. The employer initially records the prior service cost as a component of other comprehensive income, and then they charge that prior service cost to the pension expense over the remaining lives of the employees who are expected to benefit from that change in the plan. The cost of the retroactive benefits, including any benefits provided to existing retirees, is the increase in the projected benefit obligation at the date of the amendment. Companies should not recognize those retroactive benefits as pension expenses in the year of amendments. They should recognize them as pension expenses over those service lives. There are two methods. There is the year of service method, and there's straight line amortization. So to illustrate, we're going to use Zorro Company again. And we're going to assume that Zorro Company's defined benefit pension plan covers 170 employees. In its negotiation with the employees, they amend the pension plan on January 1st. And then they grant $80,000 of prior service costs to those employees. The employees are grouped according to their expected years of retirement. So we have each group, the amount of employees, and their expected retirement year. So here we take those numbers. So each of those groups, remember there were 40, 20, 40, 50, 20 respectively, A through E. And we flip it and apply it to the service years coming. And those are the years 2018 through 2022. And we plug each number of employees into the years that they would be with the company. So these 20 employees will be there in 2018, and they will be there in 2019. These 50 employees will be there in 18, they'll be there in 19, they'll be there in 20, and they'll be there in 21. And we do this across the entire time frame and all groups. This gives us a total service years to work with. So computed on the basis of the prior service cost of $80,000 and a total of 500 service years for all of the years, the cost per service year is $160. That is $80,000 divided by the 500 years. The annual amount of amortization is then based on $160 cost per service year. So there's a total of 170 service years in 2018. There's 170 employees. We multiply that by 160, and that gives us 27,200. In 2019, there's 130 service years. Multiply that by 160, and we have amortization of 20,800. And we carry that through all the years to account for all 500 of the service years. So in using a pension worksheet, we're going to use Rydell. And Rydell has all of this pension data, which applies to its pension in 2017. We're going to work through the pension worksheet with prior service cost existing. So first we start off with the projected benefit obligation of $56,000, and then they had plan assets of $56,200. That means that we would have additional liability we would need to recognize of $13,800. Currently, the plan assets are less than the projected benefit obligation. This means that we need to account for that. On January 1st, 2017, Rydell Corp., through the plan amendment, granted prior service benefits having a present value of $120,000. So we have $120,000 underneath the prior service cost. Then we also increase our projected benefit obligation by $120,000. You'll notice that for every debit, there's a credit in each of these lines. This gives us a new balance on January 1st, 2017 of $680,000 for our projected benefit obligation, $546,200 for our plant assets. Service costs for the year are $58,000. The settlement rate was 9%. So that comes down to $61,200. Our asset return was $52,280. We have prior service cost amortization of $17,000. We had contributions paid or funding of $65,000. Then we had benefits paid to retirees in the amount of $40,000. This gives us a journal entry of this information. And a total increase in the liability of $135,720. So the journal entry for 2017 is $83,920 pension expense, other comprehensive income prior service cost of $103,000, pension asset liability credited $121,920, and cash paid out of $65,000.